It's no secret that China's economic growth would be weaker without fiscal support. Inflation is near zero, consumer spending has been weakening, so it's no surprise that the markets are cheap and pricing in very little growth. We believe that much needed fiscal and monetary stimulus could be the positive catalyst the market needs. According to forecasts from Bloomberg, market expectations are for GDP growth to be 5% this year and 4.5% next year, while the government is sticking with its 5% targets for both. A fiscal stimulus targeting infrastructure and construction activities could create a surge in demand and be inflationary for global commodity markets. Chinese CPI was 0% in September. However, keep in mind that services inflation makes up 40% of the inflation basket, and as of end September was running at 1.3%. Services CPI has risen almost 1% since the COVID restrictions were lifted earlier this year. Any uptick in goods or services inflation could help lift Chinese overall inflation. The PBOC, however, is in a difficult position. It is having to balance providing liquidity to the financial system, additional funding to the government for its fiscal spending programs, and maintaining currency stability, especially with US and Chinese interest rates heading in the opposite directions. The equity market is cheap relative to history, almost as cheap as it has been since 2000. The market isn't pricing in much for growth, and market expectations for sales and earnings have been declining since the start of the year. With not much positive priced in and the government stepping in to support the economy, the markets could be positively surprised going into next year.